December 18th, 2024. The Federal Reserve cuts interest rates by 25 basis points. Markets expected this. But what they didn't expect was the signal that followed. Only 2 more rate cuts projected for 2025, down from 4 cuts anticipated just 3 months earlier. The Dow drops over 1,000 points in minutes. Treasury yields spike. The dollar strengthens briefly, then weakens again. And gold? Gold doesn't care about any of it. On December 17th, gold closes at $4,126 per ounce, a new all-time record. Not just for the week, not just for the month, but for all of recorded financial history. Up 27% for the year, outperforming the S&P 500, outperforming bonds, outperforming nearly every major asset class on Earth. But here's what should get your attention. While the Fed was cutting rates and Jerome Powell was telling us the economy is performing very, very well, something else was happening in the background. Something the headlines missed completely. U.S. employers announced 170,891 job cuts through November 2024. That's the highest total since 2020, the pandemic year. That's a 54% increase compared to the same period in 2023. And these aren't just small companies restructuring. Intel cut over 15,000 employees. Tesla eliminated 14,000 roles. Cisco shed more than 10,000 positions. The tech sector alone cut 150,000 jobs across 525 companies. This isn't a strong labor market. This is a labor market showing cracks, while gold is hitting records. And the timing tells you everything you need to know about what's actually happening beneath the surface. Let me show you exactly what's driving gold to these levels, why layoffs and a weakening dollar are creating the perfect conditions for precious metals, what the Federal Reserve's December decision really means for your purchasing power, and why this pattern, this specific combination of factors, has appeared twice before in modern history, 1929 and 2008. And both times, what followed changed everything, because this isn't just about gold setting records, this is about a system under stress, a currency losing credibility, and a flight to safety that's just beginning. The layoff data tells a story that contradicts every official narrative about the economy. According to Challenger, Gray & Christmas, the firm that tracks corporate job cuts, U.S. employers announced 71,321 layoffs in November 2024 alone. That's the highest November total since 2022. But it gets worse. October 2024 saw 153,074 announced job cuts, the highest October total since 2003. Through the first 11 months of 2024, over 1.17 million job cuts were announced. To put that in perspective, that's 54% higher than the entire year of 2023. And we're not talking about temporary furloughs or seasonal adjustments. These are permanent layoffs, restructuring, downsizing, companies eliminating positions that aren't coming back. The sectors tell the story. Technology companies led with 141,159 job cuts through October. But government was even worse, announcing 307,638 layoffs, driven largely by federal workforce reductions. Telecommunications, retail, and energy sectors all showed elevated cutting patterns. Now, the official unemployment rate sits at 4.1%. The Bureau of Labor Statistics tells us the labor market is cooling but stable. But here's what those numbers miss. The layoff and discharge rate, which measures the percentage of employed people who lose their jobs involuntarily, hit 1.1% for 2024. That sounds small until you realize it represents about 1.7 million people per month being laid off or discharged. And the October 2024 JOLTS report showed something concerning. Layoffs and discharges reached 1.85 million in a single month. That's up from 1.78 million in September. The trend is clear, more people are losing jobs involuntarily, and companies are getting more aggressive about cutting costs. Why does this matter for gold? Because layoffs are a leading indicator of economic stress. Companies don't cut thousands of workers when they are confident about growth. They cut when they see revenue declining, margins compressing, and uncertainty ahead, and when companies see that, smart money sees it too. Gold doesn't move on what the economy is doing today. It moves on what investors believe the economy will be doing 6 months from now. And right now, layoff data is screaming that the strong economy narrative is a lie. But layoffs are only half the story. The other half is the dollar. And what's happening to the dollar should terrify anyone holding their savings in cash. The US dollar had its best year since 2015 in 2024, strengthening against most major currencies. The ICE US dollar index, which measures the greenback against 6 major currencies, rallied significantly through most of the year. The Canadian dollar fell to multi-year lows near 69 cents. The Brazilian real hit historic lows. Even the British pound dropped 1.7% despite a resilient UK economy. But here's the twist. Despite this apparent strength, the dollar is showing cracks, and those cracks are widening fast. First, the dollar's share of global reserves continues declining. from 71% in 1999 to just 58% in 2024. That's a 13 percentage point drop over 25 years. And the pace is accelerating. The last 2 years saw a 4 percentage point decline. At this rate, the dollar falls below 50% by 2030. Second, the dollar's share of international trade settlement is collapsing even faster. In 2022, 73% of global trade was invoiced in dollars. By 2024, that fell to 58%, a 15 percentage point drop in just 2 years. This is the fastest de-dollarization in history. Third, and most importantly, the mechanisms that supported dollar strength are breaking down. The Federal Reserve cut rates 3 times in 2024, bringing the federal funds rate down from 5.5% to 4.5%. But here's the problem. Inflation remains sticky at 2.7%, well above the Fed's 2% target. That means real interest rates, the actual return after inflation, are barely positive. And when real rates are low, the opportunity cost of holding gold instead of dollars drops to almost nothing. Now add the December 18th Fed decision. Powell cuts rates again, but signals only 2 more cuts in 2025 instead of 4. Markets interpret this as hawkish, rates staying higher for longer. But here's what markets missed. Powell said inflation readings were the single biggest factor on officials' minds. Translation: inflation isn't going away, and the Fed knows it. This creates a trap. If the Fed keeps rates high to fight inflation, they risk triggering more layoffs and a deeper recession. If they cut rates aggressively to support employment, they risk reigniting inflation. There's no good option. And in that scenario, gold becomes the only asset that doesn't require the Fed to be right. Let's talk about what's really driving gold to these levels. Because it's not just one factor, it's a convergence of forces that hasn't happened since 2008. Central bank buying remains the foundation. According to JP Morgan estimates, central banks purchased over 1,000 tons of gold annually for 3 consecutive years through 2024. That's the highest sustained buying since the 1970s. China, Russia, Turkey, India, Poland, Singapore. Every major emerging market is converting dollar reserves into physical gold. Why? Because they watched what the US did to Russia in 2022. The US froze $300 billion in Russian central bank reserves and cut Russia from SWIFT. That showed every country watching dollar reserves can be seized. Your wealth isn't safe if America decides you're an enemy, so they're diversifying. Gold can't be frozen. Gold can't be sanctioned. Gold is the ultimate neutral reserve asset. And here's the key insight. At current gold prices around $4,300 per ounce, central banks don't need to buy as many tons to reach their target reserve percentages. If central banks with less than 10% gold reserves want to hit 10%, they need about 2,600 tons at $4,000 gold. But at $5,000 gold, they only need down 200 tons. The buying pressure remains, just with fewer tons. That supports prices at these elevated levels. Second, geopolitical tensions are accelerating. The war in Ukraine continues. The Middle East remains unstable. US-China tensions over Taiwan are worse than ever. And we're entering a period of unprecedented global elections. Over 50% of global GDP represented countries that held major elections in 2024. That political uncertainty drives safe haven demand, and gold is the ultimate safe haven. Third, inflation isn't going away. Despite the Fed's claims that inflation is moderating, the November CPI came in at 2.7%, up from 2.4% in September. Core inflation, which excludes food and energy, remains elevated. Housing costs, which make up a third of CPI, are still rising. Food prices continue climbing. And now there's a new threat, tariffs. President-elect Trump has proposed 25% tariffs on goods from Mexico and Canada, plus additional tariffs on China. Economists across the political spectrum agree. Tariffs are inflationary. They increase the cost of imports, which gets passed to consumers. If Trump implements these tariffs in early 2025, inflation could spike back toward 4% or higher. And the Fed would be forced to choose between fighting inflation with higher rates or accepting elevated inflation to avoid recession. Gold thrives in that environment. It's not an investment. It's insurance against policy failure. And right now, every policy path leads to failure. Fourth, the dollar's purchasing power is evaporating. Since the Federal Reserve was created in 1913, the dollar has lost 98% of its purchasing power. What cost $1 in 1913 costs $32 today, and that devaluation is accelerating. From 2020 to 2024, money supply expanded by over $5 trillion. That's 25% of all dollars ever created, printed in just 4 years. When you create 25% more of something, its value falls. That's basic economics. And gold is reflecting that reality. Gold isn't rising because it's suddenly more valuable. Gold is rising because dollars are becoming less valuable. The gold price in dollars is just a measure of dollar devaluation. Now let me show you the historical pattern, because this exact setup has happened twice before. And both times, what followed destroyed wealth on a scale most people can't imagine. In 1929, the economy looked strong. Stock markets were at records. Unemployment was low. Consumer spending was robust. But beneath the surface, cracks were forming. Corporate debt was elevated. Margin lending was excessive. And the Federal Reserve was tightening monetary policy to cool speculation. Then October 1929 arrived. The market crashed 89% over 3 years. Banks failed by the thousands. Unemployment hit 25%. The Great Depression destroyed a generation of wealth. But here's what matters. Gold held its value because gold was money. And when everything else collapsed, people who held gold survived. In 2008, the economy looked strong. Housing prices were rising. Unemployment was low at 4.7%. The Fed had been cutting rates to stimulate growth. But beneath the surface, subprime mortgages were defaulting. Banks were leveraged 30-1. And the entire financial system was built on debt that could not be repaid. Then, September 2008 arrived. Lehman Brothers failed. The S&P fell 57% in 6 months. Home prices collapsed 40%. Unemployment hit 10%, and $16 trillion in wealth evaporated. But gold? Gold went from $720 in 2008 to $1,923 by 2011. A 167% gain while everything else was destroyed. Now look at today. Layoffs accelerating, dollar weakening structurally, central banks buying gold at record levels, inflation sticky, geopolitical tensions rising, federal debt at $36 trillion. The setup is identical to 2008. The only question is timing. And this is where the December Fed decision becomes critical, because Powell just told us something crucial. He said the economy is performing very, very well, strong growth, low unemployment, solid consumer spending, everything is fine. But if everything is fine, why are companies cutting over 1.1 million jobs? If everything is fine, why is the Fed cutting rates at all? You don't cut rates when the economy is strong. You cut rates when you're trying to prevent something bad from happening. Powell is telling us one thing while the data shows another. That's called a credibility gap, and markets are starting to notice. Gold at 4,326 is the market saying, we don't believe you. Gold at 4,326 is investors voting with their money. The pattern is clear. When central banks lose credibility, capital flees to hard assets. And the only hard asset with 5,000 years of history as money is gold. So where does gold go from here? The forecasts tell a consistent story. J.P. Morgan projects $5,000 per ounce by Q4 2026. But here's what matters more than specific price targets. The structural drivers remain intact. Central banks will keep buying. They have to, because de-dollarization isn't a choice anymore, it's necessity. Geopolitical tensions aren't going away. The conflicts that drove safe haven demand in 2024 will continue or escalate in 2025. And inflation won't reach the Fed's 2% target anytime soon, especially if tariffs are implemented. That means gold has a floor. Even if gold corrects 10% from current levels, dropping to $3,900, the fundamental bid remains. Central banks buying 750 tons per year. Investment demand from ETFs adding 500 tons. Asian consumer demand stable at 300 tons. That's over 1,500 tons of structural annual demand. And mine supply is only about 3,000 tons globally. The supply-demand dynamics support higher prices structurally. But the real question isn't where gold goes. The real question is what happens to the dollar. Because gold is just the mirror image of dollar devaluation. If the dollar loses another 30% of its purchasing power over the next 5 years, and history suggests it will, then gold doesn't go to $5,000. Gold goes to $6,000, $7,000, maybe $10,000. Not because gold is more valuable, but because dollars are less valuable. This is the reality most people don't understand. You're not watching gold rise. You're watching currencies fall. You're watching the end of a 50-year experiment in pure fiat money. An experiment that's failing in real time. And the people who see it first are the ones who won't be destroyed when it finally breaks. Here's what you need to understand about timing. The setup is complete. Layoffs accelerating, dollar weakening, gold at records. But crashes don't happen on schedule. They happen when a catalyst appears, a trigger that forces liquidation. In 1929, it was margin calls. In 2008, it was Lehman Brothers. In 2025 or 2026, it could be anything. A major bank failure, a sovereign debt crisis, a geopolitical shock. The trigger doesn't matter. The system is fragile. And when the catalyst appears, gold won't fall with everything else. Gold will be the asset everyone is desperate to own. The December 17th to 19 period showed us something crucial. While the Fed was cutting rates and signaling confidence, gold hit 4,326, an all-time record. That tells you markets don't believe the official narrative. They see what's coming, and they're positioning before it arrives. You have a choice right now. You You can listen to central bankers telling you the economy is strong while companies are cutting over 1 million jobs. You can trust that the dollar will hold its value while its share of global reserves drops from 58% to 50% over the next 5 years. You can believe inflation is under control while prices keep rising and tariffs threaten to push it higher. Or you can look at the pattern. Layoffs up 54%, gold up 27%. Central banks buying thousands of tons, every major bank projecting $5,000 gold or higher. And recognize that this story has been told before, twice, in 1929 and 2008. And both times, the people who held gold survived while everyone else was destroyed. Gold at 4,326 isn't expensive. It's a warning. It's the market screaming that something is broken. And the people who hear that warning, who act on it while gold is still available at these levels, they'll be the ones who preserve wealth through whatever comes next. The layoffs are accelerating. The dollar is weakening. And gold is telling you exactly what happens next. The only question is whether you're listening.